And where are stocks heading from here? Well, we welcome Ed Yardeni to Power Lunch. He is founder and head of Yardeni Research. Ed, great to have you on.
Thank you very much.
All right, why do you think the market is not reacting a little more negatively to the hot inflation read and a lowered expectation of more Fed rate cuts in the future?
Well, I think the market hasn't given up on the idea that the economy is actually resilient, that it doesn't necessarily need lower interest rates, and that if we get lower interest rates, that's just icing on the cake. The cake itself is pretty tasty, and that's evidenced by today's initial unemployment claims, which continue to indicate that the economy is doing well in the sense that nobody's getting, not nobody, but layoffs remain extremely low. It is taking longer to find jobs, according to the continuing claims, but overall, the latest labor market indicators are pretty good. And so it's conceivable that the next payroll number will show continuing improvement.
Ooh.
I know everybody freaked out about the downward revisions in May and June, which, Brian, actually made sense, that with all the uncertainty, employers would stop hiring. But then in July, we actually saw an increase relative to May and June. And I think we could have another one in the August numbers.
I was going to say, if the labor market stays strong and inflation on the wholesale level is running a little bit hotter, is there a case for a rate cut? You kind of just said there's no why cut rates when those things are what they're supposed to combat, but they're not happening.
Brian, I think that's the question of the day. And the market over the past few days have indicated the answer is yes, the Fed needs to cut. And there's been actually the Treasury Secretary said maybe they need to go 50 basis points and not just 25 basis points. And then we get today's PPI and we get today's initial unemployment claims. And maybe the answer is, hold on a minute, let's think about this some more. Yeah, I've been in the none and done camp for 2025, so I'm sticking with it. And so I'm all set to be wrong here if the consensus, which is still remains that there's going to be a rate cut in September, holds. But between now and the September 16, 17 FOMC meetings, a lot can happen. There are a lot of data points that still can be released.
And we have the Fed at Jackson Hole next week. We'll talk about more on that with Steve Leisman in a moment. You referenced cake earlier. Aside from the fact that now I want cake, let's stay on that. Because then if we got a rate cut in September, Ed, even if we didn't need one, is that just frosting? Like, does it even, will it provide another leg higher for stocks by sort of sweetening the market? Or does it not matter for the equity markets? Because as we're seeing today, Manny's going to do Manny, right? To quote the Red Sox, the markets are going to go up.
Well, it I think increases the chances that we'll have a melt up. And melt-ups are great on the way up. The problem is that they do set you up for a meltdown by definition. You don't have melt-ups without having meltdowns. And we already have a very high valuation multiple. We started out the year at around a 22 forward PE on the S&P 500, and then people started to worry about DeepSeek at the end of January, and then about Trump's tariffs that might cause a recession. And as a result of that, the PE fell sharply down to 18. It was a correction. It wasn't a bear market. And here we are back at 22, and we could go higher. And let's not forget that during the tech bubble, we went up to 25. We're not that far away from that kind of level. And so we're already in quasi-melt-up territory, inflated valuation territory. I don't think we want to get this bull market out of control to the upside, because then it creates a lot of problems.